Welcome everyone. Welcome to our webinar on fund structuring in the Netherlands. And today we are hosting this webinar because many of you perhaps have heard of the more well-known fund jurisdictions such as Luxembourg, Channel Islands, Ireland, etc. But we are getting increasingly more and more questions about why should I, if I'm a fund manager, structure in the Netherlands. So today we're going to host a webinar with experts from legal, tax, and fund managers to really hear about what are the practical realities that we should all consider if moving to Netherlands. And I will now hand over to my colleague Paul Delang. Paul, over to you.
Sure. So I'm Mari's colleague working at TAU, a fund administration business with offices in the Netherlands and Luxembourg. And indeed, we get a lot of questions about what you need to know about setting up in the Netherlands. We have a few speakers here that are giving different perspectives on the Netherlands. So we have Felix Zwart here representing the Dutch Association for Private Capital, NVP. Felix has been with NVP for almost 15 years and then brings a uniquely informed perspective about the Dutch ecosystem. We have Svetlana Baraban from Van Kampen Liem, a law firm with offices in the Netherlands and Luxembourg, and she advises fund managers on tax, legal, and regulatory considerations and providing tailored advice that are geared towards the objectives and the strategy of the fund. And we have Emilia Mamedjova here as well. She's the founding and managing partner of Everita Capital, who invest in Central European SMEs. And she's managing a fund vehicle in the Netherlands that invests in Central Europe and really brings the business perspective to operating a fund in the Netherlands and what that means for the fund manager and what that means for the investors as well. So we have kind of a well-rounded group of people to share a different perspective. So if I may start with you, Felix, on the Dutch ecosystem, as Mari mentioned, there's maybe better known fund hubs in terms of countries like Luxembourg, Ireland, Channel Islands, as Mari mentioned. So what should people know about the Netherlands? Can you give us kind of a high-level perspective about what the ecosystem looks like in the Netherlands?
Well, thank you, Paul. Indeed, for people, the Netherlands is not always top of mind when it comes to a fund jurisdiction, but I would say it offers very interesting combination of features that make it an attractive place to locate your fund. First of all, there's three things that come together in the Netherlands. There's a place where you can raise your fund. There's a broad LP base here. Consisting of both institutional LPs, but also high net worth and family office semi-professional LPs. There is a well-developed ecosystem of GPs here. So you can do investing in the Netherlands if you would like to do that, but also find co-investors for your strategy. And I think there's a well-developed ecosystem of advisors and a regulator that is accommodating to both a full AFMD license and, of course, the sub-threshold AFMD regime, which is something we'll be talking about more this hour here.
And you mentioned here, Felix, also the support functions as part of the ecosystem. And again, this may be less known. If you compare that to some of the other countries that are well known in the industry, how developed would you say the ecosystem and the support available is in the Netherlands?
I would say it's rather developed. There's a broad network of advisors who can help fund managers in a legal but also more operational approach by setting up their fund and also connecting with other kinds of disciplines that might need. Of course, we have a few of them here in the room together, but the NVP has more than 100 associated members, all people in firms who can help GPs in their investment or fund management process. And I think that's where we stick out favorably with other countries. But also the regulator is a regulator that is practical. I wouldn't say they're soft at all, but they take a practical approach, and that's something you can build upon.
All right, that is very interesting to hear that from kind of the branch or organization perspective as well. If you kind of zoom out a bit in terms of the type of fund vehicles, the sub-threshold versus fully licensed, and maybe also certain strategies, what are some of the trends that you're observing in the Netherlands and in the Dutch investment ecosystem specifically?
For the sub-threshold regime specifically, we've seen quite substantial growth the last couple of years. The regulator AFM put out a report a year and a half ago now, I believe, showing this very steep increase of sub-threshold managers. It's overwhelmingly the capital under management in this regime is private equity venture capital. Well, although there are only a minority of the fund managers actually, so there's a very long tail of fund managers doing other kinds of strategies. But yeah, it's proven to be very popular for SME private equity investors and venture capital investors, both deploying their capital in the Netherlands, but also across Europe. And that's one trend, I would say. Another trend is that we're seeing increasingly fund of funds aimed at high net worth individuals and family offices investing in private equity venture capital funds. So that's also a fertile ground for raising your fund here.
Very good, very good. Well, thank you for sharing kind of the macro perspective on the Dutch ecosystem. If we dive into some of the details and then turning with the questions to you, Svetlana, obviously we'll cover some legal and some tax considerations and then some regulatory perhaps as well. But if we start off with the legal side of things, and if we consider setting up in the Netherlands and specifically a sub-threshold vehicle, what are some of the key considerations fund managers should be aware about, and also in what scenarios would the Netherlands be perhaps a favorable option compared to some of the alternatives? You're on mute, sorry, Svetlana.
Thank you very much, Paul. So from the key legal considerations that you have to take into account when you're thinking of setting a fund in the Netherlands, we can distinguish between two main aspects. One, obviously, something that everyone always talks about, being the tax, right? You want to make sure that you create a tax optimal structure for both your investors, but also, for yourself as the team. So you have to consider whether you want a tax transparent vehicle versus a tax opaque one. And in considering that, you have to look at how large are your stakes in underlying portfolio companies, who are your investors, where are they based, how large their tickets are going to be, and obviously also where your team is based. So all those questions are taken into consideration when designing the best structure, let's say, from tax perspective. Another very important angle is regulatory. And that is something that is constantly developing throughout EU mainly. And there are a number of questions to ask yourself. So in order to benefit from this sub-threshold regime, you have to look at the assets under management. And when we're talking about assets under management, it's very important to understand that we're talking about the value of the underlying portfolio. So it is not how much money are you going to raise, but it is how valuable, right, are the assets that you're currently managing within the group, or that you're planning to manage. So if at the moment of setting up your fund, you do not have any other assets in your group of alternative investment funds, then it's safe to go with sub-threshold regime. If you do already have some group entities, certain assets, then you have to look at certain thresholds. So whenever you are managing alternative investment funds that are closed-ended, that means that investors cannot redeem their interest within at least 5 years, and those funds also are not leveraged, then up to 500 million assets under management, you can still benefit from sub-threshold regime. if you do have leveraged funds in your portfolio, or they're open-ended in nature, then the threshold is 100 million. Another important aspect is, who are you going to offer your funds to? So who are going to be your investors? If we're talking only about professional investors, no problem at all. If you also want to market to non-professional investors, retail investors, there are again some thresholds. So then you can offer to less than 150 persons, or you can offer tickets of 100,000 or more per investor. Now, an important consideration to take into account, and a question that is often asked, what do we do with marketing rules? Can I just offer, being a Dutch sub-threshold fund manager, the interest in my fund widely throughout EU? The question is no. You do not, as a sub-threshold fund manager, have a marketing passport, versus if you would be a fully licensed one, where you would have a marketing passport for offering to professional investors only. So what are your options? There are certain considerations to take here. So imagine you're offering just to a handful of European investors, and those are investors that are very familiar to you, that are truly in your network, and that have reached out to you first, the so-called reverse solicitation. Then probably, although reverse solicitation should never be a marketing strategy, it could work that you offer it without to them without any kind of passport. If those investors are not familiar and you are actually actively offering interest to them, you have to look on a country by country basis, what are the local rules for offering there. There are also passporting options available for sub-threshold fund managers, the so-called EUVECA and EUSUF labels. Those labels are, although more burdensome to obtain than a simple registration regime for sub-threshold fund managers in the Netherlands, but by far not as burdensome as having a full license. So it's actually an excellent way to remain sub-threshold, not be heavily regulated, at the same time have this marketing passport, and that passport allows you to also market to non-professionals, as long as the tickets of non-professionals 100,000 or more. Those labels you can obtain if for EUVECA, if you are investing in SMEs, so small and mid-cap companies in either Europe or countries that are not listed on as a non-cooperative country on the different lists. And for the EUSUF label, if you are investing in companies that want to achieve positive social impact as a their primary objective. So in the Netherlands, as a trend, it's interesting. We've seen quite a bit of big rise in the past years, especially of the EUVECA label applications. And it's really successful tools that a lot of fund managers use in order to have the best of both worlds. On one hand, benefit from sub-threshold regime. On the other hand, have a marketing passport. And to come to your questions, Paul, why would you choose Netherlands and not some of the other well-known jurisdictions? So first question is always to ask yourselves, who are going to be my investors? If you're talking about institutional investors, if you're talking about DFIs and those type of investors, they typically do not accept offshore jurisdictions. So then you are left with the familiar, let's say, European jurisdictions, and you named a few, like Luxembourg, for example, and they're having a lot of experience in both jurisdictions. I can truly mention that there is a big difference in terms of costs. Setting up a fund in the Netherlands, both as the kind of establishment expenses and the ongoing expenses with your service providers, are considerably lower, let's say 30 to 40% if we compare to some other jurisdictions. Another topic is also how easy it is to set up the sub-threshold structure, and the regulator in the Netherlands is really, as Felix mentioned, quite facilitating in that respect. It's not a cumbersome process, not an expensive process. It's €4,000 fee to the regulator. It can be done truly in a matter of weeks. So there are a lot of, I would say, competitive advantages when we are talking about the Netherlands.
That is a very comprehensive answer to my question. Thank you, Svetlana. And maybe as a follow-on question, if you look at, you mentioned an opaque or a transparent structure, what are the most commonly used legal vehicles that are used to set up fund vehicles in the Netherlands? Can you maybe share some of the options there and their key characteristics?
Definitely. I think when we're talking here, mostly, we're talking about closed-ended structures, and we're talking a lot about, let's say, PE, VC funds. That's truly the Netherlands is a jurisdiction where those vehicles are set up a lot. And then for those kind of strategies, we see a lot either a Dutch cooperative or a Dutch limited partnership, a CV, Commanditaire Vennootschap, being used for open-ended structures or more, let's say, local fund managers where you're attracting more pension money, even for closed-ended ones. FGRs are used a lot, and FGR is a fund for joint account. It's a kind of contract between the fund manager, custodian of the assets, and the relevant participant. But when we go back to, let's say, your average, European or third country fund manager wanting to establish in the Netherlands, PE or VC fund, you really look at this cooperative versus a limited partnership. And there, it depends whether you would choose for one or the other. Indeed, a cooperative is by itself a legal entity with a legal personality. That means that it holds its own rights and obligations, and it acts as a tax blocker. And it's let's say it's a bit of a mix between between a contract like a limited partnership and you're like a limited liability company. So it does still have a bit more rules that are mandatory around corporate governance, but it's still very flexible, commercially speaking. And it has been used in the past years a lot for fund managers seeking to establish Dutch structure, which attracts DFI capital. So Dutch cooperative is very well known there. Then a limited partnership. A limited partnership generally is a very familiar structure because you have a GP-LP structure in UK, in Delaware, in Jersey, in Luxembourg, right? In all those jurisdictions. So for investors, it's really familiar. It's very flexible. There's very little mandatory laws around it. So you can truly use it as a good tool to structure your commercial needs. It is tax transparent typically. So that means that from tax perspective, investors are treated on a look-through basis, right? As if they invest directly in those underlying portfolio companies. And it's in the past, the reason why it has not been used as much as in some other jurisdiction is because for tax reasons, we had a very odd rule that for all the transfers or all the admissions of new investors, after 6 months from the first closing, you needed to get unanimous approval of all other investors. Of course, certain investors saw that as burdensome. Certain GPs saw that as burdensome because for a lot of them, it is important to create the secondary kind of trading opportunities. Now, this rule has been abolished, and we saw a surge in this, in using this LPGP structure, just because, again, it's familiar, it's flexible, it's easy. And maybe, okay, there are some tax considerations. Maybe we tackle it a little bit later.
Yeah, so just before we turn to tax, Svetlana, you mentioned the timeline in terms of dealing with the regulator. That's measured in weeks rather than months, I suppose. And if you think about the full timeline from fund formation, setting up the legal entities up to the registration with the regulator, could you kind of take us through that timeline, what that would look like to kind of, on average, what people should be anticipating when setting up a sub-threshold fund?
Definitely happy to do that. So there, it is very important, again, to distinguish between the various stages. So the first stage would be always kind of the designing the structure, establishing the entities. And that is quite a straightforward process in the Netherlands. In order to establish your fund manager, we don't need to open bank accounts first. We don't need to deposit certain amounts, right? It's really a matter of typically a notarial deed, and the registration with the trade register, which is done within a day. So it is a simple process which is done in a matter of days, provided that you first have passed, of course, your AML KYC barrier, which you have with your legal provider, but also with your service provider, so your administrator, right, your fund administrator. So I would say take into account that you first need to go through this AML KYC process with your service providers. Once you've done that, you can focus on establishing the entities, which is really easy and short. Then typically, if you would want to already soon start to operate as a fund manager, you would go and register your fund manager with the regulator. So indeed, that is truly a simple process. It's a matter of, let's say, a couple of weeks that you prepare the documentation, you submit it to the regulator, and if you're first-time fund manager, there is formally no waiting period. You can already start operating. If you are existing fund manager, let's say registering your second fund, there is a 2-week waiting period. So it's a really straightforward process. You could get some questions, of course, from the regulator, but it doesn't prevent you from starting to operate. Now, generally, in parallel to this more notarial and regulatory process, there is, of course, process of actually drafting the fund documents that you will share with your investors, right? And that kind of runs in parallel. So to prepare those documents is a matter of weeks. To negotiate those documents with your investor is a very distinct process, depending very much on your investor base. When we are talking about family offices, when we are talking about perhaps retail investors, when we're talking about smaller group of investors, right? It's a simple process, typically doesn't take a lot of time. When we are talking about institutional investors, when we're talking about DFI investors, that process can really take a longer period. And we're talking from months to sometimes half a year, sometimes a year. And the reason for that is because you first have to attract that capital from the DFIs, so institutional investors, which already takes certain hurdles, takes certain IC decisions, DDs being done. And then once you've secured that, and your lawyers have prepared the fund documents, you really negotiate typically every dot and comma with those type of investors, and they have a lot of distinct own requirements, which are then put in separate documentation, like the side letters. You also typically would expect those type of investors to ask your lawyers to prepare legal and tax opinions to ensure that it's a solid structure from legal, tax, regulatory perspective, and all that, let's say, takes time. So we've seen very different processes from beginning to the end, matter of weeks, or beginning from to the end, matter of years. It can be both. So very much depending on your investor base and not so much on the regulator or the service providers, let's say, in the Netherlands.
Got it. That's a very good perspective to give that if I summarize, dealing with entity formation and dealing with the regulator should be the easy part. It's actually getting terms agreed with your investors is what may take more time. You already mentioned, Svetlana, that there's some tax considerations as well, and you covered on some of those already, but what would be the primary considerations that fund managers would really need to focus on when setting up in the Netherlands? Can you kind of summarize those, and maybe as part of that as well, go into substance a little bit, because that's often the question: what do I need locally to run a fund in the Netherlands, from maybe both the regulatory substance perspective as well as the tax substance perspective?
Yes, indeed. Those are all very good questions. So when you look, and I already a little bit discussed, right, those two main structures being one a cooperative, another one a Dutch CV. So typically the main consideration is, what is your investment strategy? If your investment strategy is to invest in underlying portfolio tickets of 5% or more, so you are holding 5% or more of shares or interest in the underlying portfolio companies, then a Dutch cooperative could be very interesting, because as mentioned, it's tax opaque, is a tax blocker, it benefits from a wide there are so many, let's say, tax anti-double taxation treaties between the Netherlands and many different countries. So it really it benefits from a lot of EU regulations. So it's a very useful structure from tax perspective when you are investing north of this 5%. And also quite a lot of investors like to invest in a tax opaque structure because they don't have to deal tax-wise, let's say, right, was a part at least of the process, because the fund itself is, the taxation happens already at the level of the fund, doesn't trickle further to them when we're talking about portfolio company level. So it's a structure that's used a lot. At the same time, it could be also beneficial, and some investors prefer to invest in tax transparent structures. So when we are not meeting this threshold of 5%, we always look at the GPLP structure, the Dutch limited partnership. And there, sometimes some issues might arise because, as mentioned, it's tax transparent, and you would want to put some tax blockers when you're structuring your deals. So depending on a deal-by-deal basis, to be seen whether a tax blocker is needed. Sometimes what we see is structures being used of a Dutch limited partnership with a co-op there under that kind of already acts as a tax blocker. Sometimes we see is a tiered structure of a master and feeder, because you would have certain investors that want to invest in a tax transparent vehicle, so a master fund of being a Dutch limited partnership, and some of them want to have that tax blocker and want to have a cooperative, so we will put it on top of it as a feeder vehicle. So that is kind of the variety in short what you see. And then substance is a very indeed important question. It always comes up. And the interesting thing is that, from Dutch tax perspective, an entity that is established in the under Dutch law is Dutch from Dutch tax law perspective. So from Dutch law perspective, you don't need to do anything else to prove that it is Dutch resident. However, right, so for foreign sponsors, there's no specific Dutch law substance requirements. However, we always recommend at least to have minimum substance to safeguard Dutch law residency from foreign tax law perspective, so that if your team is, let's say, in Romania, your Romanian tax regulator doesn't say, great that you have this Dutch cooperative, but in fact, it's a Romanian taxpayer, right? So there, you could go, I would say, as broad or as simple as you want, but there are a few things that are quite essential. So I would always recommend having some board meetings in the Netherlands, at least a couple times a year. The bookkeeping and admin should be done from the Netherlands, and that's the role for your Dutch service provider, who would be doing that for you. Then very often, at least 50%, sometimes more, of your directors at the level of fund manager should be Dutch. That is also often a role that the service provider takes. And that's great, truly, for the fund managers, because it means rather than having to relocate here, right, they can engage a director from a service provider, and that is sufficient for that reason. Then a bank account. It's a tricky question. Very often it's assumed that your bank account has to be in the Netherlands. We all know that in the current environment, it's harder and harder to open bank accounts in the Netherlands. So we're saying it is not a hard requirement, but at least it should be managed from the Netherlands. And there again comes into play your service provider that helps you doing that from the Netherlands, because your office, your address, your seat is going to be in the Netherlands. That is again all provided, all right, by your service provider, and they also facilitate, let's say, physical meetings of your investors or proxy meetings of your investors that are also then take place at their offices in the Netherlands. So I would say, although there are some requirements, it is not burdensome for the fund manager, because you don't have to relocate your team here. You don't have to open your own office or rent your own office, right? All that can be arranged with your service provider. And that is different, I have to say, from some other jurisdictions. In some other, also European jurisdictions, we have seen more increased requirements in terms of substance and really require either relocations or having an office, which of course substantially could hinder you in your business or increase the costs. And even and that also really is a big distinction, I would say, with some other jurisdictions, even for UVECA or OSEF labels, where there is increased substance in the sense that the directors are really being reviewed by the Dutch regulator in terms of their background, whether they're fit to manage a certain strategy. But there aren't any increased substance requirements in terms of people on the ground or offices. And that truly is much lighter than in some other jurisdictions.
Well, very, very good to have that detail as well, because indeed we have these conversations all the time as well. And it's one of, next to marketing, I think substance is quite high on the list on things that people want to learn about. So there we have the legal and tax perspective as well. If we then turn to the business perspective a bit more, Emilia, maybe before we go to the considerations of setting up in the Netherlands, could you maybe share a little bit more background on the fund that you're managing, the strategy, the investment thesis, so that we have a bit of context as well before we go into your experience in the Netherlands?
Hi, thank you, Paul. So I'm a co-founder of Everita Capital, which is a fund based out of Prague, investing in Central Europe. We're investing a 2 to 5 million euro ticket per transaction. We're focusing on sectors like healthcare, education, business services, specialty manufacturing, and consumer goods. And this is the second fund we set up, but it is structured as a first-time fund because the team is new. So we went through the same kind of a process of establishing the fund manager from scratch. We've had really great experience for working with Svetlana and the team from Fund Company Liam, because when we raised the first fund, we didn't really know much about the fund structures and Dutch fund structures. So having an experienced advisor on the ground who also knows when you deal with EIF, European Investment Fund, or other DFIs, they know what terms are acceptable or not acceptable. So this really makes the process smoother and more efficient. So I think this is absolutely critical when you consider any jurisdiction you have no experience with, to really try to choose the best providers on the market, because it saves you time and it saves you also money at the end. So one more thing about our fund, we are focusing on SME companies. The key markets are Czech Republic, Slovakia, Poland, Slovenia, and Croatia. And one angle of our strategy has been focused on companies which have also women in the leadership roles. The reason for that is that we saw a huge gap between what the funds typically invested in and what attractive targets there were in the market, but not aware of the investors being there to help them scale. So we're trying to bridge that gap between these SME companies and the funding that helps them scale internationally. And yeah, so I think that's kind of a quick intro. As I mentioned, we're now with the second fund, which we had a first closing in September 2025. So we're still in the fundraising, and we're raising 40 million euros. We secured commitment from European Investment Fund. So this is also one of the reasons we wanted to stick with Holland. We have a Dutch cooperative, which was described by Svetlana, and it has worked very well, not only for EIF, but also for local investors, a lot of them coming from Czech Republic, but also some international, even American citizens. So, and family offices, we had family office from Germany, for example. So it is a known, reliable jurisdiction that is cost efficient and worked even for the first fund, which was below 20 million euros. So based on that previous experience, we decided to keep the same same setup.
And maybe if we go back a bit before you had your first fund in the Netherlands, and then you started to kind of look at options, what was interesting about the Netherlands, and what maybe actually tipped that decision to eventually set up in the Netherlands? What were the aspects that really were attractive for you to choose Netherlands? And I think you mentioned a couple of even before you were in the Netherlands. What was driving you to set up here?
So we saw this as a cost-efficient way. We knew of other jurisdictions that are much more expensive to even start, and then also to maintain the vehicles, because each of these entities requires some administration fees, etc. So we knew this is not a one-off; it's a recurring cost you have to pay every year. And if you have a small fund, every euro matters. So we had to really look at that aspect of it. Then we were comfortable with this light manager light kind of regime, which was very flexible. We were able to attract investors who came from our circle of business contacts and some other kind of institutions or family offices that had awareness of us, and we could use this reverse solicitation regime in the markets of Central Europe. So we didn't need a marketing passport and didn't need a full license because it's a sub-threshold manager. So this was all kind of fitting well with our strategy and our LP base. And other aspect was that we discovered a fund similar to our strategy in Holland, which is Carmine Capital, and they already were investing with this gender lens investment strategy. And as we got talking to them and saw some kind of a potential for cooperation, that even reinforced our interest in Holland, because one of their founders is also one of our directors in the entity. As Svetlana described, it's not so important from a Dutch perspective to have this substance, but it is relevant from a maybe more Czech perspective to have this real investment professional kind of being part of our investment committee, as well as being a director in the fund manager. So this was our specific case in this aspect. And the tax regime, as it was already described, it's very transparent. So the citizens of those Central European countries I mentioned, if they invest as private individuals, the only tax they pay is their personal income tax in the country of their residence. So they are not losing any tax on the way when the distributions happen from portfolio to holdco to the fund and to the investors. So this has worked well. And we always invest more than 5% as a fund. So this structure is very well suited for private equity funds. We were considering actually a Czech structure because we thought this could be even more cost efficient. But the concern there was that, for example, European Investment Fund has not been involved in that many cases in the local structures at the time when we were raising. And getting them familiarized with this legal and tax environment would take much longer. So we were also encouraged to choose a jurisdiction which they're familiar with, which their lawyers are familiar with, and that would make the process a little bit faster in terms of getting their commitment and being in the market, being able to invest. So that was our choice. And at the end, I think it was a more, if we want to raise money from people from outside of Central Europe, I think have a fund domiciled in Western Europe is kind of giving a guarantee of maybe more stable regime, because in Central European tax regimes things change here and there. And Luxembourg and also Amsterdam, the Holland has been known for having relatively stable environment. So there's not much change that would dramatically, change the outcome of your returns because something got disrupted. So I think this is less predictable in Central Europe, probably.
So you mentioned there already that in general it was a structure that was also kind of well received by investors. Was there any LPs where there was some explaining needed, or maybe it was unknown to invest in a Dutch vehicle, or was that generally smooth sailing, if you will?
I think it's more the private investors, local private investors who had not had experience from investing into private equity funds, considered maybe too complicated or more complicated than necessary, because if we're investing mainly in Central Europe and our team is based here, they were wondering why we need to have a fund somewhere else. But I think when we explained all the reasons and also all the arrangement between LPs, GPs, and what's necessary to have the, everything in place that is typical in private equity, that it was more straightforward and legally binding in this Dutch setup than it would be in Czech. There would have to be a lot of extra stuff created to kind of put the same kind of terms in place and same procedures, So I think they were comfortable with it. They were just curious because they haven't really experienced it in the past.
Good. And if you again go all the way back before you set up the first fund in the Netherlands, is also as kind of some advice to other emerging managers maybe that are considering setting up in the Netherlands. Is there anything you know now that you wish you knew before you started that journey?
I think we were lucky to work with who we worked with, who we, as same like your firm, Taru, has a lot of experience. Then we worked with Praxis FM at the time, which is no longer existing. So it's a Trustmore team that we work, and having like Van Kamp and Leem on the tax legal, even preparing the tax memo, all of that was very helpful for kind of getting off the ground and getting also negotiations started with EIF to be prepared with all this documentation. So I think there was a smart move to go early with them and not make mistakes and try to go back and fix things. Maybe if I knew what I know now, I wouldn't have a fund because I would be discouraged. But the fundraising took much longer than we anticipated. And I think that doesn't change. I don't know if it gets worse or not, but it's just always a very lengthy process. So I think whoever's trying to raise a fund should be prepared that it can double to what you probably expect at the start. And even if you think that on your side, you can be super efficient and quick and have 100% focus and turn around everything in one day, all the documents, you need the other parties to be equally quick, and you cannot push in certain cases at all. So I think this is something the one has to count with, that also the cash flow, if you're focusing purely on that, and you like working 1 or 2 years on raising a fund, you have no income, you have to be kind of prepared for that journey if this is a first-time fund, So you can do it part-time alongside your job for a certain period, but once it starts to get more serious, it doesn't work like that. So I think this fundraising part is probably the most challenging. And then again, having EIF, having credible advisors is something that also enhances credibility in the eyes of more sophisticated investors. So
yeah,
it goes hand in hand.
I think the fundraising conditions are still not far from easy. So I think it's a good piece of advice, and maybe sometimes it's also underestimated how challenging this can be and how much time it takes. So I think that's a very valuable advice to share, Emilia. So thank you for that.
Yeah.
I think we have kind of covered the different perspectives. So maybe I can hand back to you, Mari, for some closing remarks.
No, absolutely. And thank you so much, Emilia, Svetlana, Felix, and of course, Paul. So just to summarize, I think we've heard some great insights about why you should really consider Netherlands for your next fund. So just to summarize some of the things that the panelists mentioned, obviously the it's a cost-efficient option. Investor familiarity, Emilia and I think Svetlana, you mentioned EIF. Location, Felix, and I think Svetlana mentioned as well, it's not kind of considered offshore, it's in the middle of Europe. Everyone loves to come to Amsterdam for their board meetings, right? If needed. Speed to market, in most cases, as you mentioned, Svetlana. extensive ecosystem of not only service providers such as Taru and Van Kampen, Svetlana, but also there is a big market of both institutional investors and family offices, as Felix mentioned. Obviously, substance rules is something that's relatively relaxed compared to some of the other jurisdictions. And I think those were some of the key considerations. But I wanted to just thank you to everyone who's watched this webinar. We have produced a white paper on the topic that goes deeper into some of these topics, and that is available in the NVP website and also Taru's website. And if you do have any questions and want to continue discussions, please do not hesitate to contact any of us, and myself, Paul and Svetlana will be happy to assist you in your process of setting up your fund in the Netherlands. But thank you so much, and thank you for dialing in.